Well, good morning, everyone. Here we are, the Three Consulting Amigos, prepared to do another session. And today what we want to do is kind of go over some of the measurements that are really important to know whether you're on track or not. This is kind of in conclusion of our Baldrige assessment, and we did results this last week. So today we're going to start looking at real closely the things that you have to measure to know whether you're doing well or not. And I'm going to kick it off here with Ron, who put together this first slide so that you can get a better understanding of what we're talking about and what it means to your business.
Great. Thank you, Ray. I've shared it, and I believe that we're ready to start. We thought we'd talk, as Ray said, we just kind of thought we would talk about key business metrics. And you can put this in different words as well, but these are sort of like the things that we think are so important to look at. And we're trying to boil it down to the things that are the most important versus maybe a little bit less important. But as you know, in terms of going through this and putting it together, it became pretty apparent to me that most of these key indicators having to do with financials are really kind of necessary. I couldn't figure out really what not to put in it. So we'll go through and we'll talk about each one of those. Here they are. Number one is profit, of course. And we'll all talk about these as we kind of go through this, but then we'll have a little kind of show and tell following each one of these, or I should say at the end, and then we'll talk more about each one. Sales percentage change. Now, you could say, well, you know, what are your sales? Of course, you want to know what your sales for the month are or for the period, certainly for the year. But to me, sales is relative. If you don't know how it compared to last month or last quarter or last year, it's kind of hard to know. Now, you may know kind of where your sales are at any given point in time. I think an awful lot of business people really do know exactly what their revenue is. They kind of almost gauge their success based on their revenue, but that's really not the case. You really need to understand how it's changing, whether you're going ahead or going behind. And that's the same thing with expense. You know, while you want your sales to go up, generally speaking, your expenses, you'd like to keep the same or actually have them come down. And therefore, while the dollars of expense that you are spending are really key and very important, the change in whether or not you've made progress on increasing sales and decreasing expenses, or at least not increasing as fast as sales, is really important. So I like expense percentage change. Third is the cost of goods sold. And of course, the reason for that is that if you take a look at, you really can't get to profit unless you do have your sales dollars and your expense dollars. But unless you understand what it costs you to sell those goods, you really can't calculate the difference, because it's sales minus cost of goods sold minus expenses equals profit. So you kind of have to have all of those in order to be able to get just the basics. And your cost of goods sold is important as a percentage, and I should have delineated this. I really like to see it as a percentage of sales, so that if you have a 50% cost of goods sold, or cost of sales, then you want that to go down if possible, meaning you're going to buy better, or you're going to have a better manufacturing operation and lower your expenses, or you're going to control all of the components, say in manufacturing, so that you can have a better margin. But increasing your margin is probably one of the best things you can really do. And then contribution margin. This is just a little bit different than the margin or the cost of goods. The margin is what's left after cost of goods that you use to pay your expenses. So the contribution margin, though, can also be really beneficial when looking at break-even analysis and a little bit deeper analysis after just knowing these key figures. And then we jump from all of those would be on the profit and loss statement, but then we also need to know whether or not our inventory has changed or not. And that happens to be a balance sheet item. And we'll talk a little bit about that. And Ed's going to give us a lot more on those two things in our next program. And then I like to throw in break-even point because the break-even point tells you it's really kind of a collective. It doesn't include inventory, but what it does do is it takes all of these numbers into account, and it tells you at what point you go from a loss to zero to finally making a little money. And that's an important thing to know because you need to work and I was going to say manipulate, but I don't really mean that, but to fashion, and you can do this, to make sure you get enough sales and that your expenses do not increase too fast and that your cost of those sales is not too high, creating a strong contribution margin. And all of those things are really measured then, can be measured by the break-even point and where you're going to be going. And we're not going to talk much about the break-even point today because that's a whole program in itself. But I do have later on, if you have a pencil, later on you can write down the location where you can find a program that we've already done on break-even point. But that's not all. There are other things in your business. Those other items have to do with employees, and you want to keep track of your people. And there are two or three key things there that we're going to talk about in just a minute. I thought I had changed that slide, but I guess it's going to show up here a little bit later, and we'll talk about that. Ray is very involved in doing employee training and in all types of HR matters, and watching how your employees are impacting your bottom line in terms of costs. And we'll talk a little bit about that too, because those are also very key. Keeping track of your human resources is important. So let's kind of move into just a really quick overview of each one of these pieces. At the bottom, you see number one is profit. And in this particular case, we had a profit in the first period of $17,000, but it dropped to $12,000. So is that good or bad? Well, you want to know your profit as a percentage of your total sales, of course. But what we're measuring in this particular case is showing how profit changed. And in this case, we had almost a 30% drop in profit from one period to the next. And then, and then I did calculate so you can see that one is a 17% profit, which is really, really strong. There are not a lot of businesses that can do a 17%, but this was just an example. And then the other one is 12%. So that's not terrible at all. But the question is understanding how that profit really impacts whether it's reasonable or not reasonable. And if you're used to getting in some businesses, smaller businesses can have an 8, 10, 12% profit, particularly if they're sort of on their own. And we hope that if they're not taking a salary, that they're making this much profit on a monthly basis. But you do want to understand those relationships between the percentage against your revenue that you're actually keeping or losing, and of course how that changes from month to month and quarter to quarter. Oops, I'm sorry. This is I sort of did this on the fly. It's out of sequence a little bit. I apologize for that. But here are the workforce items. Absenteeism, turnover, and productivity are the key issues here. We'll come back to that and have Ray speak to that. Then number two is revenue. And we have our revenue listed here, first period, second period. You can see that there was just a 0.2% increase between one period and the other, but it was an increase. And so you would consider that really good. On the other hand, if we go to number 3, we take a look at expenses, and expenses went down 7.9%. But remember where our margin, our profit also went down. So that's really a key thing, is in your expenses are broken into different pieces. And again, we won't be able to talk about this in detail today, but they're broken into fixed and variable expenses. And one of them has to do with whether or not they go up or down based on your revenue. In other words, they sort of climb with revenue. Cost of goods sold, by the way, is something that almost always climbs in tandem with revenue because it costs you a certain amount, say, to buy the goods that you're going to resell. But expenses also are important because they tend to creep up on you. And one of the biggest expenses most businesses have is labor. So if labor is creeping up on you, it can be a real problem. So in this particular case, it was good to see that the labor was going, the total expenses dropped a little bit. And as a result, you did have a drop there. And so that's great. But that calls into question what really did happen and why did that happen? And so here we can see that the cost of goods sold actually went up. And so we went, we went up 4.4%. Well, when you have a 2.2% increase in revenue, almost nothing, that's really the same. And then you have an increase, a substantial increase in your cost of goods sold, meaning that it's costing you more to sell each item that you sell. Then that can lower your margin quite a bit. And by lowering the margin, and which is number 5, you end up changing your profit picture. Now, the point here is that each one of these things needs to you need to be aware of each one of these things to see how each one affects the overall business and the direction that you're going in terms of sort of the trends of your business. You can't necessarily extrapolate that things are going to be the same next period at all, but you can certainly know much more about where your business is going and what you can expect the next period by knowing what's happened, say, the last couple of periods. Number 6 is inventory. Now, this is sort of a fake and mostly blank balance sheet that Ed's going to be showing us the complexities of. This is highly simplified just to make this point. But it's interesting here that while business dropped a little bit and it was even, and the cost of goods sold went up, that we lost some, our profit went down, didn't lose money, but our profit went down. Well, what also happened in your business? Well, if the expenses had gone up a lot, we might say, well, you've hired too many people, but your inventory may go up and go down. And so if you now have more inventory than you had last period, and in this case, just a $5,000 change increased your inventory by 16%. Well, what that does is that takes up part of your cash because you got to pay for that at least in 30 days. And so that begins to hurt cash a little bit. And inventory can expand so much that it uses most or all of your cash up. And that's a very critical piece to be able to watch your inventory. If you're reselling merchandise, if your inventories get too low, it'll affect your revenue. So while we're not going to talk about how to control all of those today, wanted to really make the point that inventory was really a very key piece of this. Okay, so here I wanted just to recap each one of these pieces that we've talked about, and I've got the break-even point right here, so that those of you who would like to be able to find out more about it can go to our show on the MicroGiants YouTube channel and just type up Startup Planning Part 3 Financial Verification, and you'll end up finding us. No problem. And then let's go back here. I'm sorry, these are a little bit. Ray, would you like to talk a little bit about the workforce elements of absenteeism, turnover, and productivity?
Yeah, I think, basically, when you're dealing with micro businesses, this isn't necessarily a problem since you probably have few employees. But when you start having employees, these three can be very helpful in determining, what kind of a culture you have and whether it's really supportive and aligned with what the people who work there are or don't. Absenteeism typically is more prevalent in cultures that don't support individual effort, and the people don't feel like they're really engaged, so they'll spend time doing other things as opposed to working for you. Turnover obviously is very important because basically the higher your turnover, the more difficult it can become to really maintain any type of the profits and the points that you were making, Ron, about the financial aspect of the business. When you look at turnover, the estimate is that for every time you have a turnover, it takes roughly 6 months to a year to recover from that loss. So losing people can be extremely expensive and really hurt the bottom line. Finally, productivity. People who are really engaged, as Ed has said over and over again, typically will perform at a much higher level and produce and be productive in ways that you can easily measure and see that, when you have an engaged group of people, productivity goes up. So those three all contribute to the bottom line, which you were referring to in the first place. Ed, I'd appreciate your kind of feedback on this, looking at the numbers that Ron was kind of highlighting and why this is important. And I think next week you're going to be going over a lot more detail on this with the balance sheet. So thank you again.
Well, I think it all starts off with the premise that if you really want to progress and build value, you have to measure progress, which means you have to identify, first of all, what you want to measure. And I think Ron did a very nice job explaining the components of really key measurements that should be made in determining whether you're making progress. So that's the first step. And then you have to do it consistently. And that means every month you're going to go through the same process, which means you got to have your financial statements up to date quickly. And, you should, at the end of a month, and most people are on a monthly basis, you should be closing your books, generating financial statements and reviewing them as a team. One of my clients has done, he just does a year, they just keep looking at the numbers every year to date as they go through the process without closing the books. And that seems to work too. Everybody's got a different way of doing it. But the key is that the numbers have to be prepared in accordance with generally accepted accounting principles, because otherwise you might be mixing things you shouldn't be mixing, and you might think you're doing better than you really truly are. So to me, there's three financial statements that you have to look at, and you have to look at them together as a group. And that is the income statement. And a lot of the things that Ron put on his list, it's on the screen right now, come from the income statement. Mm-hmm. The balance sheet is just talking to a banker this morning. The balance sheet, it doesn't seem like very few people understand what a balance sheet is. We're going to get into that a little bit later on in some other programs, but they don't focus. They focus on the income statement because they really understand it, but for the most part, they don't have a clue on the balance sheet, and the balance sheet is really, really important. So the key metrics on a balance sheet that you probably should be looking at, and number one is working capital, current assets, less current liabilities. And That's one key aspect. And the other thing would be the percentage of debt and the percentage of equity. So, and in the working capital is inventory and accounts receivable, as well as all your ongoing payments that you make to stay in business. And then the last item is that you could be making a lot of money on a statement showing that your profit is very high, but your cash flow isn't translating properly into your bank account. So that's why you got to look at your cash flow statement also, which is the third statement, and we'll get into that later on in the program.
We've done in MicroGiants, we've done cash flow programs, a couple of those cash flow programs, and we also have a very careful illustration of how you go through and you actually build a real cash flow, which is slightly different than the sources and uses of cash statement, which is many times prepared by your CPA. That's really important because what it does is it goes from here forward. It tries to identify where you've been, but it also, by using these same numbers, but it also looks forward to determine, well, what would your future revenue be? What would your future margin be? What will your future expenses be? And if you do that correctly and conservatively, you can identify whether your cash is expected to go up or go down. It's highly possible and I had a business early in my career that grew very rapidly. The first year was 60%, the second year was 50%, the third year was 40%. So I mean, it was an exploding business, and it was an inventory-based business where I had to have inventory in order to be able to drive this huge increase. But it didn't take very long for us to as I showed in that inventory example, to where the inventory was 400% higher than it was when we started. And the interesting thing there is that we were making profit, but there was negative cash. It was all in inventory, and of course the vendors still wanted to get paid, and all the salespeople still wanted to get paid. Strangely enough, everybody wanted to get paid. It's funny how that works, huh? And so there was an example, and I had to learn that really the hard way. There are limitations to how fast you can grow if, in fact, you need assets. You have to buy assets in order to grow, whether it would be equipment for manufacturing or inventory for retail, or several other assets. And that balance sheet really is the place where you can determine what's going on with your assets and your liabilities, and how much wealth are you retaining, or how much surplus are you storing up for a bad day, or getting ready to invest in new assets to create more business. So yeah, that'll be good to go through, and I would encourage all of you to tune in again next week and in the following weeks. I'm not sure how long it will take us to get through these, but to really get a good sense for what it's about. And when Ed goes through it, it can be a complicated subject, but he clarifies these things and makes them simpler to understand than maybe your CPA might be able to do. So that's because while he is a CPA, he's been a COO, an operating officer for many, many years, and is used to communicating this to other management and teams. So
that's true. And I think, we did a great job here explaining some of the basics for understanding how well you're doing for measuring results. But you also have to do forecasts into the future. You have to do projections. And that's where a lot of people don't want to get involved, because they see a lot of liability with projections. But in reality, you can't run a business unless you have some idea what your revenue and expenses are going to be for the next year and years thereafter, because it drives everything else on the metrics of your business. So
by some people, you're speaking of your accounting folks.
Yeah, I mean, CPAs normally like to
Yeah.
focus on the past, because there's generally accepted accounting principle which they are experts in, and making sure that the statements are being prepared in that manner, so that there isn't any funny stuff going on. But then a good CFO type or controller or business owner has to project into the future what he thinks or she thinks the financial statements are going to look like. And that way, when you're moving forward and you close the books, you get an idea, well, okay, we said we were going to make this amount. How much did we actually make? And if we didn't make that amount, what's the reason why? So it's an ongoing process of fine tuning the numbers based upon what you record in the past.
Right.
And it all has to work together that way. And unfortunately, a lot of businesses don't operate. They'll operate that way. They'll just look in the bank account, and from that they determine whether they're doing a good job or not.
Yeah, and I think it's so important to reemphasize that while this program was just sort of saying, okay, here are the key things, and most businesses are doing most of those things. I would guess the question is on a frequent basis or not. Doing it on a yearly basis, I would suggest, is just not enough. Quarterly might be okay. I've always preferred seeing things on a monthly basis, although you do have period changes where some money goes into the next month and it should have been in last month and that sort of thing. But in a quarterly basis, usually kind of takes some of that out. So there's maybe an advantage to doing a quarterly statements. But I think I wanted to return to the whole idea of analysis. I mean, by looking at these, I guess we could call them key performance factors or ratios, we're not really we haven't talked about the analytical part of what happens when you do that. And I think it's really, it's very key to take this another step. So we've kind of just exposed what do you look at? That's fine, you got them. And now the question is, but what do you do with them?
Yeah.
And Ed will work some of those things into these next couple of programs, and I'll just kind of leave with a little bit of a story, a success story to show how powerful these can be. I have a long-term client which they sold to the children, bought it at fair market price, low fair market price, but in order to do that, they had to give them effectively a loan. And so what the parents did, which was also done by the grandparents, I might add, what the parents did was put together a series of KPIs that they had to adhere to. In other words, minimum profit, minimum growth, minimum each one of these things. And I think there were 23. So if you think that, having the 5 or 6 key things there that we pointed out seems complicated. Realize that no, they get a lot. They should be more complex than that, especially as you grow. So by making sure that these minimum numbers were met, which were reasonable, having to do with a variety of key performance indicators and a range of performance that was acceptable. What that did was, on one hand, it said your loan could be suspended if you don't maintain these things, just like a banker would. Bankers are not going to give you the money if you can't perform in a certain way.
Right.
But what it did for the two kids, who are no longer kids in their 30s and 40s, but what it did for them is it helped them understand that for the first, until they paid the loan off, which, the first 4 or 5 years, and it could have been much longer, but they were high performing people. And it kept them on the straight and narrow. It kept their eye on the ball. It's so easy to get focused on all of the bazillion problems that come up, labor issues and, no parts and high gasoline prices and all the things that hit a small business every day, that you could easily forget about what you're really doing. And this is sort of a guidepost. That's why it's so critical to make sure you have these key performance factors and that you look at them in a regular basis. And that ties into having a board, by the way, because you tend to do this if you've got an advisory board that you have to get ready for the meeting. When you let these things slide, 1 month comes and another one goes, and pretty soon you're 4 or 5 months down the road and you haven't gotten a decent statement, and you've made mistakes on the financials and you haven't corrected, and it's cost you a lot of money. And I think that's the key thing is that these keep you on track. This is like driving the car. You wouldn't think to just let the steering wheel go where it wants to, because you'd be off the road. I mean, in a matter of feet, potentially. Newer cars are better, and if you didn't have the brakes to tell you, or your speedometer, how fast are you going, or your gas tank has so much inventory in it, if you're watching these dials all the time in order to get down the road, your business is the same. You've got to have dials, and that's what these are. They're your dials.
That's a good analogy. Well, Ed, do you think, is there anything else you want to add, or do we want to?
No, I just think what Ron has just explained would be another great program. And that is, we talked about 8 different ways of transitioning your business to the next ownership. Probably one of the most frequently used and most comfortable with most family is transferring a business over to the next generation, which means you got to prepare them to take on this responsibility, which Ron has pretty much summarized it being treating it as a normal business. You don't give anybody any special concessions, whether they're family or not. You expect them to hit separate or predetermined metrics so that you're on track, as he says. And that would be a good program, because that's where a lot of transition happens. And that's where a lot of problems develop, because they're not treating the business as a genuine, bona fide business.
Yeah, right.
Good thought. So I think that would make an interesting program as we move forward. Unless there's anything else, I think this was good. Ron, thank you so much. I believe that your summary of these important financial metrics are something that can really benefit, not only us personally, but the small businesses who are, obviously very interested in what we are doing here. So thank you very much.
Yeah.
Thank you.